Okay, I think we could start. Good afternoon, everybody. I'm very, very happy to see you crowds back in the room. I hope that you all had a very good lunch and very good chats, because we all know that normally this is most of the most important things on these conferences, but I'm pretty sure that I will be able to, let's say, sweeten up your siesta, and I would be very surprised if anybody would get asleep during the next 1.5 or 1 hour, because we have a very, very exciting subject to discuss, which is financing the transition to sustainability. And I would like, first of all, congratulate the EEB to bring up this very, very important subject on the agenda. Now, as you can see on the slide, I would like to take the opportunity to very quickly introduce myself. My name is Constanze Adolf. I'm director of the Brussels office of Green Budget Europe. Now, Green Budget Europe is a multi-stakeholder platform or an experts platform promoting market-based instruments and working on something called environmental fiscal reform. So we heard a lot about that, which is environmental taxation, which is EU emissions trading scheme. We work a lot on environmental harmful subsidies, border and carbon adjustment, and so on. What you can see here on the slides is some of our partners. You're very well welcome to become a partner as well. And Green Budget Europe, as such, brings together a broad group of representatives from mainly high-level decision makers from the European Commission, from ministries. It's businesses, it's international organizations, it's NGOs, it's political decision makers, as I said, and of course the research communities. Now, and as you can imagine, the main partner, the main target groups of our organizations are not ministries of environment, but ministries of finance. So let me very briefly say a little bit about environmental fiscal reform. You all, I think most of you may know the rationale behind it, which is the fact that pollution causes external costs to the economy and the society, as long as prices do not reflect the real costs behind it, so behind certain products and behind certain services. And environmental fiscal reforms is exactly there. It aims to increase the price of polluting activities, also known, as you know it as well, the so-called polluter pays principle, and to put that into action for the environment. So it's also about decoupling or decoupling growth from environmental quality or quality of life. And so what the economics behind says is that a traditional tax disturbs markets, while environmental taxation corrects market failures, and that's why it's quite efficient. And I don't want to go into detail because I don't want to take the time of my panel. What you can see here is a little bit of an advertisement, because we organize our annual conference next week in Switzerland, and you are most welcome to be there. Now, what I said about environmental fiscal reform is only theory, and we heard that a little bit before. In practice, we can see that CO2 emissions do not reflect at all the level of taxation and in products or services we buy. They are not reflected in most of the private financial sector, and that's what we are going to talk about. And this leads to a counterproductive situation where coal, the most polluting fossil fuel, is taxed considerably less than, for instance, oil, gas, and diesel. To give you some numbers, these are latest numbers of the European Commission. Fossil fuels are subsidized by EU money with nothing less than 26 billion a year. Every ton of CO2, as we know, that is created will have impact on the cost of abatement and on our health system. I don't know if anybody from HEAL is in the room, but HEAL is a member organization of EEB, I think, as well. And they made a study that the annual cost of CO2 emissions to the health system account for 40 billions. We have nuclear, which still receives 35 billion euros per year of EU money. And I don't know if you're aware about company cars. Company cars, let's say the money that is not taxed because of company car subsidies is 54 billion a year. 54 billion a year just because of taxes. This is not our numbers, this is official EU numbers, by the way. So, and what about renewables? We are by 30 billions. So this is 30 billions against 106 if we sum up nuclear, coal, and the health issue. Congratulations if that is what the EU means by sustainability. I can go on. We know about the heavy dependence on fossil fuel imports. We have got about 500 billion in fossil fuel imports per year in the EU. We have the cost of inaction, and we talked about later, further on, which accounts, according to the DG Climate, of 50 billion a year. We have 1.4 trillion euros of fossil fuel subsidies worldwide per year. We lose important climate funding tools due to, of course, really nearly no existing carbon price. But governments still increase their austerity measures. Just to let you know, my own country, Germany, bailed out their own banks by 400 billion. Now, as a consequence, the EU risks locking in high-risk carbon infrastructure, while climate change will raise significant costs into the future. Now, this is all about, let's say, the scope of the public sector. We are here now to talk about the private sector. And what I said, all the numbers that I told you before are just peanuts if we go into the private sector. I think we will hear more from the experts, but what I heard about is there's an incredible disproportion between the financial sector and the real economy. Worldwide, the financial transactions amount to 810,000 billion euros, which is almost 15 times higher than the world GDP of 54,000 billion euros. And in the US, the financial sector's share of total profits was doubled from about 1/3 to 2/3 in the last 2 decades. Now, the question is, where has all this money gone? Where is all this money now? How can we use the current crisis to transform it into a real opportunity? How can we energize the debate as to leveraging private finance to bring about a transition to sustainability and to creating a supportive and just regime? And that's why we're here. And now I'm very much honored to welcome our first and the keynote speaker, which is Sony Kapoor, who will inspire us about how to make private finance deliver for sustainable development and a common future. Let me very shortly introduce Sony. You are managing director of the international think tank Redefine, and you are interested in reforming the financial system in crisis management and the economic development. Until recently, you have been the first chairman of the European Banking Authority Banking Stakeholder Group, as well as a visiting fellow at the European Commission, and of course, then it's very short to be also an expert to the European Parliament. As this is not enough, you advise the OECD, the Institute for New Economic Thinking's Council on Euro Crisis, and a number of high-level institutions. At the London School of Economics, you serve as a strategy advisor to the Systemic Risk Center. You are a senior visiting fellow on development and a visiting fellow on government department. And before I still continue, I would just give you the floor. Thank you very much to be here.
Microphone. Okay, sorry about that. That wasn't intentional. Now, I think we're running late, so I'm going to be quick and short. But here's what's going on, and I'm not going to do anything structured. Look at our pension funds. They are buying assets that are yielding negative real rates of return. So our pension funds are heavily invested in some government bonds, including German bonds, US treasuries. And the returns on some of this, once you account for inflation, are like -1% or -0.5% and things along these lines. Equity markets have recently started rebounding, but things are again not going that great. And on the whole, we face an environment where all of our so-called private funding universe of sovereign wealth funds, of pension funds, of mutual funds, insurance firms, and their investments are facing, and also including our old friends hedge funds, are facing a very challenging environment in being able to be profitable or generate returns of the kind they used to before the crisis. So this is one end of the spectrum. And we are talking here about total financial assets in the world of between 150 to 200 trillion dollars, right? Trillion. The other environment is we have in our house, and if any of you live in the UK, a terrible situation where your gas heating bill is very high, your insulation is almost always very, very terrible, despite the fact that the EU has now outlawed old-fashioned incandescent lamps and all of that. Many of them remain in our houses. And if you started doing the financial math, if you came with your financial sector hat and started looking at some of the returns on investments that can be had by tackling this, you can get more than 90% return on your investment if you just go around and change all the light bulbs in your house. You can get, depending on how bad your present insulation is, between 10, 20 to as much as 30% return on investment on actually changing insulation in your house. And we're not talking here about 1 or 2 households. We're talking here about millions of households. We're talking here about tens of billions, tens of billions of incandescent lamps across the 500 million or so citizens we have in the European Union, right? So why are those investment opportunities that can deliver a rate of return of 50% every year not being exploited by people desperate who are earning a rate of return of 2 or 3% or maybe at most 5% a year? It's ridiculous. And this goes to the heart of the failure of the financial system. This is nothing more than a complete failure of financial intermediation, together with some failure from the policymaking community. Now, there is a good thing and a bad thing. So the bad thing is what I spoke about, that there has been a huge, significant, continuing failure, which also continues in the future. The good thing is, this is a low-hanging fruit. Connect the two, and everybody is better off. Your pension funds will suddenly start making money. Your consumers will start saving money. And at the same time, the EU will not need to import whatever it is, 400 billion or so in some of the energy imports that it spends money on every year, with a significant proportion of the money going to let's say, questionable, dodgy regimes, which in addition then pose a security risk to us. So here's roughly the situation. And of course, this failure is not just on the private front. Let me give you an example. We've recently, as Redefined, managed to score a little victory, which I'm hoping will not be so little. And this goes to the Norwegian Sovereign Wealth Fund. Now, every politician, including Michel Barnier here, speaks about long-term investors. You know, who can be against long-term investors? Everybody is in favor of long-term investors. But what does it actually mean? And who is actually a long-term investor? Now, the headline numbers on what is the total pool of long-term investment is bandied around. But it's often in the few trillions of dollars, right? 20 trillion, 30 trillion or something. Now, once you start looking at who they are, a significant proportion of them are actually pension funds. And these pension funds actually cannot really make 20-year investments. Many of them have to actually fund, because demographic decline, countries such as Germany and also in many of the other places in Europe, the population is starting to age, and all the people who save money are now starting to withdraw it. So the pension funds, some of them can be long-term investors, some can't be. Then you have the various insurance firms, you have so-called mutual funds, and you have other funders such as hedge funds and so-called sovereign wealth fund. Now, once you start looking at how the people running this money actually behave, what incentives they face, so the risks that they face are measured, and this is partly the fault of our regulation, by looking at what is the volatility of the stock market? What is the volatility of your portfolio? What is it worth today? What is it worth 1 quarter from now and 3rd quarter from now? Now, if you have a 10-year investment horizon, you don't care. This is just noise. And we have very inappropriate accounting systems. We have very inappropriate risk management systems, some of which are driven by market practice, some of which are driven by regulators, which means that these investors, which have the potential to be making investments for a 10, 20-year horizon, actually cannot in reality do so. Then you have compensation structures where the performance of fund managers, people who run our public money and private money and hedge funds and everybody else, is measured on a regular quarterly basis. And frankly, it is very hard to reconcile an environment where performance is measured on a quarterly basis with an investment where your money is locked in for 10 or 20 years, where you don't know till the end of 5 or 10 or 20 years whether this investment was profitable or not. So there is a huge problem of the incentive structure of the accounting system, of some of the well-meaning financial regulatory legislation that is supposed to keep us safe. That makes a substantial part of the financial system incompatible with the kind of long-term investment that everybody thinks we need, right? So that's one big thing to take on. Now let me here use the example of a public sector fund. Now the Norwegian Sovereign Wealth Fund is funded by the sale of oil and gas. It is the largest sovereign wealth fund in the world. It is worth 750 billion US dollars, right? Now, I was, between 2007 and 2009, a strategy advisor to the Norwegian government. I moved there in 2007. I looked at the portfolio. Out of the 10 largest investments, 5 were in oil companies. Now, you don't need to be a financial genius. All you need to know is your grandmother said, do not put all your eggs in one basket. The whole financial system, the whole risk management landscape works on the basis that you diversify your risk. And here is a fund where all the money is coming from oil and gas, and it is going to continue to invest in oil and gas. This is beyond stupid. Now, we have, in the past few months, in the run-up to the Norwegian election, managed to get a change in strategy. So what we tried to do was to try and explain to them, and this may be, maybe everybody in this room is really smart, but apparently this is not a simple message, and you can tell me if I've somehow failed to convey this, which is, so they say that their current portfolio, only 10% of it is invested in oil, gas, and coal, right? And they say, but that's not much. And I say, that is a ridiculous way of looking at this. So right now, they're worth 750 billion US dollars. They are going to be worth double this by 2025, $1,500 billion, with all the new money coming from the sale of oil and gas, right? So I say, okay, fast forward to 2025, look back at your 1.5 trillion portfolio, which is supposed to be the expected value based on current projection of oil and gas and current, carbon prices. And more than half of your portfolio is actually exposed to oil and gas. So what you need to do to make commonsensical diversification is immediately sell off all oil, gas, and coal investments. And in addition to that, actively seek investments which reduce your risk, which diversify your risk, which means investments in solar power, investments in green energy, investment in green infrastructure, etc., which will actually reduce your risk. Fortunately, the new government that has come in has just announced that they will look into setting up a special fund to do exactly that. Now, how big it will be, I don't know. But at least it's a partial success. I've brought a copy of the report, but you can actually get it on our website if you want. And I think this is an interesting thin end of the wedge, because what makes sense for the Norwegians makes immediate sense for all the other sovereign wealth funds which get their money from oil and gas and coal. And so we are suddenly talking here about some real money. We are suddenly talking here about 5 trillion US dollars of money, which has a special incentive to invest in the kind of green transformation that we need. Now, why is that so? Well, here's a simple reason. Just assume you're a normal pension fund. So you have nothing to do with oil and gas, right? And you're trying to get a return of, let's say, 5% or 6%, which is what a lot of pension funds do. And let's talk here about not the kinds of high return investments of energy efficiency that we were talking about, but let's say you are trying to set up a wind turbine, which will generate a rate of return of 4%. Let's say it's a marginal investment. You don't think it's very attractive, okay? So you say, okay, no, thank you, I'm going to pass on this. But that is because you don't have a massive exposure to oil and gas. If I'm the Norwegian Sovereign Wealth Fund, that same investment looks much more attractive to me, because even though it only generates a return of 4% rather than 5 or 6, at the same time, it actually reduces the risk of my portfolio. So there is a special incentive for all of those funds which get their money from oil and gas to be actually, and this is a contradiction in terms in a way, right? They are the ones that have the biggest incentive to be at the leading cutting edge of green investment and the green transition. And fortunately, at a time when the rest of the world is financially insecure, this is a set of funds which is actually still raking in money. As long as Syria remains uncertain, as long as Middle East uncertainty remains, they're going to continue to accumulate a significant amount of money, which is a bad thing perhaps for the world overall, but is an interesting opportunity for financing the green transition. Once you start looking at various other aspects, so you ask yourself the question, why doesn't this green investment happen? Okay, so I'm going to compare wind turbines versus gas turbines. So I'm looking at this as an investor. Now, the cost of a gas turbine in the short term of equivalent capacity is much lower than that of a wind turbine. So it's a relatively cheap investment. And within 4 or 5 years, I'll be able to get my money back. Okay, so the way it looks is there's a small capital investment. But if you actually look at the overall 20-year lifespan of that project, over the next 20 years, most of the costs lie in the future, because most of the costs come from the fuel that is needed to run the gas turbine. It's not actually the construction of the turbine. And those costs, under the current billing structures we have in most of the European countries, can be almost immediately passed on to the consumers. So if you look at the whole parameter, over the 20-year horizon of the life of a gas turbine, the total costs paid are actually much higher than the total cost paid in the lifespan of a 20-year equivalent wind power turbine, right? But at the same time, we know that it is gas turbines that keep getting funded. And the reason is that you have the massive short-termism in the financial system, which is linked to performance measurement, which is linked to wanting to get your return on investments very quickly, which is linked to the fact that utilities can almost immediately pass on any unexpected cost to consumers. But nobody is looking at the whole ecosystem as a whole. So the economic case for many green investments is very, very strong. The financial case, if you are a fund manager, is much less strong. And what we need to do as a policymaking community is to reduce that gap. And this short-termism is one part of it. Another part of this is changing some of the billing structures. So on the one hand, and this has been tried in parts of California, where at the municipal level, at the city level, you have had public lighting, which is still those old-fashioned bulbs. And an investor says, if somebody was to change that and pocket the whole energy saving, that is a very high return on investment. But then nobody actually takes enough care. And, you know, all of us, I'm very green conscious, and personally, I confess I haven't changed the light bulbs in my house either. And I'm sure many of you here haven't either, including those who work for EEB. And the point is that, but if somebody comes to your house and changes this and actually gives you some money for it, you wouldn't say no. And that is exactly the kind of opportunities that exist. And there are small little billing innovations you can make to change that. Another thing you can make is, let me give you an example. So I went around 2 years back to speak to the statistics authorities. Now, one would say, why would somebody like me talk to statistics authorities? And here's why. So I tried to go buy a washing machine. I used to live in Berlin. And there was one for 500 euros. It had an energy efficiency rating C. And there was one for 600 euros. It had an energy efficiency rating of A. And frankly, you know, I trained as an engineer. I can do differential and integral calculus and all of that. And I was just stumped. I stood there, and I kept on trying to think, like, how do I compare these two? And frankly, you can't, because it's apples and oranges. So what we did was, we went to statistics authorities and we checked, is it possible for them, given the information they already collect, to say that the average lifetime usage cost of this washing machine will be 1,000 euros. So let's assume the average washing machine is used for an hour a day for 5 years. You know what the average expected price of electricity is. And the answer is yes. So imagine if you go and buy a car or a house or a washing machine or any energy-intensive good, and instead of apples and oranges, you see two price labels. You see the retail price that you're paying now, which may be 500 euros, and you see how much will it cost on average over the lifetime. And what you will often find is many of the things that cost slightly more now, and too many of the people don't decide on the basis of energy efficiency, they decide on the basis of lower costs. You will find that these are reversed. Even Toyota hybrids, over the average lifetime usage costs, actually look cheaper than many other cars which are not Toyota hybrids, even though it looks expensive. So once you have this information, the first thing it does is it changes consumer behavior, hopefully on a larger scale. The second thing, once you have this information, you can actually link it to financing conditions. Now, everything else being the same, if you bought a car that over its lifetime cost 5,000 euros less, because it was more energy efficient over the next 10 years than the other one, you would, as a bank, look slightly more creditworthy to me than someone who bought in the cheaper car now, but over a 10-year lifetime horizon of the loan I'm giving you to buy the car, actually spend more money. So it is legitimate for regulators to then say that if you buy the goods that have a lower lifetime usage cost, we can offer you 0.5% lower interest rate on financing conditions. And that will further amplify some of the behavioral challenges. There are loads of things you can do at the micro level. There are loads of things you can do at the level of all the regulatory changes that are happening, including looking at risk weights, etc. There are things you can do at the meta level. For example, what you can do is make all pension funds, which are actually managing your money, to say what will happen to their portfolio if the price of carbon emission goes to 30, goes to 50. These are reasonable things that can happen. In the banking system, you may have heard of stress tests. In the banking system, you may have heard of what will happen to Spanish banks if Spain continues to shrink, if the Spanish economy continues to shrink. And if the stress test that the European Banking Authority has done says that the Spanish banks will need 20 billion more capital, the EBA says go and raise 20 billion of capital, because this is a plausible scenario. The likelihood of it happening is low, but it may happen. And here we have something where, as policymakers, we have decided that we are going to tackle climate change. We keep making all these statements, and almost surely, and I'm living in hope here partly, we are going to see a future within the next 10 years or so where carbon price, for one reason or the other, is going to be higher. So it is not a kooky assumption. It is a realistic assumption which may happen. It doesn't have to happen. You don't have to say it will happen. And imagine if all pension funds, all large investors were asked to say, what will happen to your portfolio if carbon prices went up to 30, went up to 40? We want you to publish that information. Once that information exists, a simple financial approach which is supposed to manage risks will mean you will be forced to try and reduce the amount of money you lose in the event such an event happens, which means some of the bias that exists with the present financial system in making large, dirty investments which we are locking in and essentially not just being financially imprudent, but contributing significantly to climate change will go away, and the financial system will become more green-friendly. Thank you very much.
Thank you for this excellent contribution, Sony. This looks like, well, it's a kind of new and not so difficult way of thinking. It's just to put it into practice. And that's why we're here to look into how we can do that. And perhaps my next speaker will help us to understand how we could put that into practice. My next speaker is Jonathan Taylor, and I would like to welcome you as the Vice President of the European Investment Bank. You are, since the beginning of this year, Vice President of the European Investment Bank, and you are a member of the EIB's Management Committee, which draws up the financial and lending policies and takes collective responsibility for the bank's performance. Now, today you are here because you lead the bank's work on climate action and other environmental lending policies, apart from your responsibility in the bank's activities in Denmark, Finland, Ireland, Sweden, and the UK. You are graduated from Oxford, and served as the Director General of Financial Services and Stability at HM Treasury, which is the UN's UK Finance Ministry. And I would like to warmly welcome you with an applause and look forward for your contribution.
Thank you very much for that very, very generous introduction. I'm just going to, partly in the interest of time, partly in the interest of keeping this crisp and sort of generally moving along, I'm going to try and illustrate one or two of the points which we're trying to do to, as it were, make flesh some of the ideas there which Sony set out so eloquently. I just want to say three things, really. I just want to sort of, to underline 3 points. The first point I just want to underline is the scale of the problem which we're confronting here. And I'm not talking about the environmental problem or the climate problem. I'm just talking here about the financing problem, which is a consequence of that, which we need to address, just to be clear about the scale of what we're doing. Now, in the session before lunch, one or two people, I think, were sort of casting a little bit of doubt on some of the numbers in the energy roadmap. But nonetheless, taking it at face value, the energy roadmap has put in needs for the EU. It says investment needs for the EU to make a transition to a low-carbon economy by the mid-century in the range of an additional 1.5% of GDP over the next 40 years. Let's just be clear what this means. 1.5% of EU GDP is plus or minus 270 billion euros a year. Let's just be clear about that number. So where's that going to come from? Well, it's not going to come from taxes. Some of it might come from taxes, but in present circumstances, it probably isn't. So it needs to come from other sources, including, and in particular, and that's what we're talking about here, public investment and also from the private sector. We lend, and I should say that the EIB, for people who don't know it is the long-term financing institution of the EU, and it's the largest multilateral financing institution in the world, and it's in fact larger than all the others put together. And even so, if we lent everything which we lend each year, if we lent everything just for this purpose, that would be 70 billion euro. So I think that gives you a bit of an illustration of the scale of the problem. So what do we need to do? We need to crowd in private sector financing. So that's the first point I wanted to make, was just to underline that. So what are we doing to try, for our part, to try to take that forward? Well, banks like ours are there principally to leverage in monies from outside. On the back of what we do, we're able to borrow at very fine rates. We're able to lend very long term. That provides a lot of comfort and assurance to the private sector, and the private sector can then bring in the money. So we never lend more than 50% on any given project, so we're always leveraging in at least as much again. We aim to leverage in rather more than that, but that's just what we can do. We act as a cornerstone investor. So, and in doing that, of course, we're in pursuit of European Union policies, so we can insist on a strict application of environmental and social standards. So that's one thing which we can do. We're also trying to develop new ways of attracting in the financing, which we need, because like any other bank, we're lending money which we're borrowing from other people. We need to find ways of attracting financing that helps to address these sorts of points. And so one thing which we've pioneered is climate awareness bonds, where there is an explicit targeting of the proceeds of these bonds to climate awareness projects and climate-friendly projects and climate-friendly action, and these are reported on, and we have a whole system of auditing to do that. We also have advisory services which advise borrowers on how best to be taking forward these projects. And we're also seeking to develop new financing facilities where there are gaps, sometimes in conjunction with DG Klima and DG Environment, blending with grant money. So, for example, we're developing a facility called the Deep Green Platform, which is aiming to lend money specifically for energy efficiency. And we're also developing a natural capital finance facility, which will help to finance green infrastructure, payment for ecosystem financing, and so on. Now, these things are obviously specific to us, but they are things which can be, to some degree, generalized. And I just illustrate, by way of example, the green bonds side of things. As I say, we've developed climate awareness bonds. Out there is plenty of scope for these to be developed more generally across the markets to appeal to ethical investors, for want of a better phrase, all sorts of things. But in order to do this, standards need to be developed so that these can properly be developed as a sensible asset class. So that's one of the things which we can do. And there are other examples, I think, from the points which I've just mentioned about what we do, which can be used to effectively sort of marketize, to create identifiable income streams which can be used to do the sorts of things which are necessary if the monies are to be attracted in. So these are things which we can do to attract in. So that was my second point. My third point was just to underline some of the barriers which we have learnt about from our co-investors, which need to be dealt with. And in fact, I can be very, very brief indeed, because these points which I scribbled down, Sony has in fact just identified a number of them and made them which relate to things like short-termism and so on. I think there are 2 points about transparency and predictability, particularly in the context of regulation, which I want to mention. This isn't, by the way, in the sense of regulation as we were talking about it earlier on. It's more in the sense of, on the one hand, economic regulation when you're setting prices, and most energy in Europe is governed by economic regulation of one sort or another. If you set the price wrongly, you will lead to the consequences which Sony was mentioning, and more to the point, if you set them correctly, you can deal with those consequences. So that's one area where things need to be looked at. But I would add the gloss that one of the things that a lot of private sector investors have told us about that they find particularly difficult when they are thinking about investing in new and innovative areas of, for example, energy, is the lack of predictability of the regimes which they are going to be investing into. There is, and partly this is of course because of the sort of noise which there is in the sort of general debate and the way in which there is pushback on things like renewables and so on and so forth, as we were talking about earlier today. Because of all that, that adds another layer of uncertainty to what governments might do now, or governments might do in a year's time, or a regulator might do now, or a regulator might do in a year's time. And it is as important that they can have an accurate prediction, broadly speaking, an accurate prediction of what the situation is likely to be sometime hence, because then they can price their investment off that, than it is that it is set at a particular level or otherwise. The other point I just want to mention, and again this is something which was touched on, is the importance of avoiding unforeseen consequences in what is otherwise entirely sensible regulation in other areas, in particular in relation to prudential policy in the financial sector. For all sorts of reasons, which I certainly don't need to rehearse, we all know why prudential regulation is required. We all know why it needs to be tightened up. And a lot of measures have been put in place in the last few years to try to deal with that. One of the possible unforeseen consequences of that is that it has made institutions more reluctant to lend into what you might say more adventurous sorts of investment. I've got 1 minute. The sorts of investment which we're talking about here. So people need to think a little bit about that, and the same applies also, as Sonia was saying, to pension funds and so on. So I think my time has just run out. So thank you very much for that. I hope that fleshes out a bit. I look forward to a bit more discussion later. Thank you.
Great, thanks. And sorry for cut you down. I think we will have a lot of, hopefully sometimes in the discussion, to come back to that. I think we've got a very actual case here in what you said. It's like if we need predictability, but we don't know what the energy and environmental policy will be in the next years in Europe. And I think this is a very good case to be made. And the second case is about what happens at the moment with the state aid rules for energy. So I think this is a very crucial point that you mentioned. Which brings me to Alan Dorsey. Very warm welcome to you. You are the Executive Director of the Wallace Global Fund, and you hold a doctorate in social science from the University of Pittsburgh.
It's okay.
And the Fulbright Fellowship in South Africa. No, everybody gets the same rights here. I think what I've found particularly interesting that it's thanks to you that we've got the Human Rights and Environmental Program of Amnesty International, because you led this program. And currently you serve as the National Advisory Council to the board of Amnesty International. And besides of having published an impressive number of books, I just say over to you.
Hi, I'm Ellen, and I run a progressive family foundation that's based in Washington, D.C. We fund globally and we fund domestically in the U.S., and I want to just kind of tell you a story for the next little bit of time about what's happening in the United States. Not what you've most been focused on, the utter shutdown of our government, but some other interesting things. So I work in a foundation, and you know, philanthropy in the United States is very different than foundations. How philanthropy is structured in the US is very different than how it is in Europe. And our foundations, we have voluminous numbers of foundations, upwards to 80,000 foundations, which typically are structured in such a way that they have a pot of money, and by law, they have to pay out 5% or more of that money annually, and the other 95% is typically invested, okay? So my foundation funds on environment issues, democracy issues, human rights issues, women's rights issues, and we have, like many of the other foundations, focused on the climate issue. Now together, the large foundations, environmental foundations, and small ones in the United States have funneled tens of millions of dollars to the climate issue over the last 10 or more years. Let's talk about what we put that money into. We've built a robust field of environmental education. I know you don't believe that Americans have environmental education, but we have in fact spent a tremendous amount of money in environmental education. We've supported deep and rich environmental research, set up institutions for research. We've populated think tanks with analysts. Thank you so much. I move around too much, that's why I hang on to a podium. We've experimented with building new constituencies for climate change, tapping into the health field, business, labor, to join our environmental advocates to push legislation. And when we were thwarted at the federal level, we pushed at the state and local level. And we've gained some important traction, some. And we've developed and funded and plotted and mapped electoral strategies so that we could figure out how we could get climate legislation passed. But you know where this is going, don't you? We failed to get absolutely any meaningful action on federal limitations on greenhouse gas emissions, cap and trade, or even more elusively, a carbon tax. There continue to be subsidies that flow disproportionately to the fossil fuel industries rather than renewables. We've had key battles over new fossil fuel sources, and we have pipelines, laying down pipelines, new major projects. We fight each one, and climate denialism is real in the United States. It is. It is unbelievable how successful they have been at convincing a portion of our population that it is not real, despite Katrina, despite Sandy, despite health effects. So these foundations, like mine, we spent tens of millions of dollars with our 5%. And with the 95%, we're invested in fossil fuels. So I come to you with a positive dispatch from the United States, because what we're witnessing in the United States in the last several years is the most exciting explosion of climate activism the US has ever seen. And it's rapidly spreading across the pond. Taking a page from the anti-apartheid movement, the youth activists began about 4 years ago to call on their universities to divest from coal and invest in renewable energies. Since that time, that movement has expanded and exploded, linking the notion of divestment to fossil fuels and to the carbon bubble. This campaign is now on 350 campuses. It is in cities. It is in healthcare institutions. The mayor of Seattle right now is hosting a conference for other mayors. The mayor of Seattle committed to divesting from fossil fuels and using their funds to invest in climate solutions. And he's encouraging other mayors in the United States to do the same. So I want you to take just a quick snapshot look at why divestment started in the anti-apartheid movement, and it'll present a really interesting parallel. The mass democratic movement in South Africa called for government sanctions to be imposed against the apartheid state, called on the governments of the world to impose economic sanctions against the apartheid state. Activists campaigned for their governments to impose sanctions, many countries successfully. But in the United States, I was one of those activists, our government would not impose sanctions because our corporations did not want them to. And they were very successful at blocking the US government from imposing economic sanctions. But undeterred, the US activists said, okay, we're going to take it right to the industries themselves. And they started calling on their faith communities, their universities, to divest their funds from businesses invested in South Africa, and it exploded. And ultimately, you know the story. It was a contributing factor to the change process that occurred in South Africa. The change was not to be economic, though. It was to be political, to make a moral case out of those companies and to say, we will not profit, we will not make money from apartheid South Africa. Faced with a parallel situation, paralysis at the federal level, where the fossil fuel dollars have propped up subsidies, funded climate denialism, where the fossil fuel money has bought our politicians at the federal level right down to the city level in Richmond, California, activists began taking it to the industries and forging a new debate about divestment. But what's different this time? Number one, and this is what I think is linked so beautifully to what we're talking about. It's not simply a call for disassociation, get out. It is a call to divest and invest, to move money into the climate solutions of the future and the jobs of the future. Number two, this time there's an economic argument in addition to the moral argument, and that is the notion of the carbon bubble. It is every investor's in their interest to get out of fossil fuels now, because they are incredibly overvalued. You have been following the UK Carbon Tracker's analysis about this carbon bubble. Basic argument is known fossil reserves exceed by 5-fold the amount that could be burned if we're to stay below 2 degrees Celsius. So therefore, we have to keep those reserves underground. But the valuation of the fossil fuels is based upon those reserves. They're overvalued. The bubble equates to $20 to $27 trillion. That far dwarfs the housing bubble that has created such economic crisis. Okay, so I'm supposed to wrap this up, but let me tell you, there are two other differences and important things. The divestment campaign that we're talking about today is not a heavy lift compared to what happened with apartheid. It's only a fraction of the portfolios that we're saying need to be divested, and more importantly, there's enormous opportunities for reinvestment. And just to get you to think about the potential of this, if every hospital that has an endowment, if every university that has an endowment, if every pension fund, if every healthcare institution, and guess what, lo and behold, foundations, who, especially nonprofit institutions given charitable tax status because they serve the common good, would divest their funds from fossil fuels and liberate those funds to seed climate solutions, we would have an enormous flow of capital. So I'm going to ask you to join this wave. It's coming now. The Quakers in the UK just said they're divesting. There's universities in Europe that are taking this up. Join with us. Get your pension funds, your churches, your universities to divest and invest.
Thank you so much for this very eluding and encouraging presentation, Ellen. I think this is nothing to add on that. What I could add is just to warmly welcome Stanislas Dupré, who is the Executive Director of the 2 Degrees Investing Initiatives. You developed the first assessment methodology for financed greenhouse gas emission of financial institutions already in 2007. And in 2012, you set up, or you created the 2 Degrees Investing Initiatives, and I'm very, very curious to hear more about that. Your team is based in Paris and Beijing, and I also read that you are not only lecturer at the Paris Dauphine University, so another university that might have an interest in, in divest, But you also serve as non-executive director to a green private equity fund, another opportunity, and a member of various experts committees related to climate-friendly investing, including Greenhouse Gas Protocol, UNEP, financial sector guidance, and so on. And the rest is up to you. Over to you. Thanks.
Okay, thank you very much. So unfortunately, the Paris Dauphine is a public university, so we don't have any endowment. But I've got also incandescent light bulbs in my corridor, so 2 bad points, sorry for that. So basically, I will start, just briefly introduce our organization. So we are a membership-based organization financed by the French government, French public banks, as well as commercial financial institutions. We've got a lot of different type of stakeholders among our members, environmental NGOs, asset managers, risk managers, asset owners. And the idea is really to understand how we can integrate climate goals in financial regulation. So our approach picks up on the very basic and widely observable fact that climate policies are almost exclusively industrial policies. Feed-in tariffs, subsidies, tax incentives designed to foster the green economy. The policymaker shown here thus tries to pull private capital toward green investments. Equally, the muscles, the pulling power of this policymaker have not sufficed so far. The market price of carbon is a good example of that. It is about 10 times lower than the estimated minimum level required to drive investors' behavior, and 20 times lower than the external cost of carbon emissions, as calculated by the US government. While it is safe to assume that with increasing workout and practice, this policymaker will become stronger, investors seem to be largely blind to rising point-in-time carbon risk from new policies. As a result, they don't deliver the necessary flows of capital, and they assume this skinny new guy in the gym will give up or stay weak forever. So to fix this problem, the creation of new climate financial instruments, like climate bonds, is becoming an increasingly popular idea. So the idea is to turn long-term risky assets, such as investment in infrastructure and SMEs, into liquid securities that become, to a certain extent, drinkable for risk-averse investors. So, we think this is a good idea, but it can only be a part of the solution. First, a lot of green investment might be eligible, but many others isn't. The cost of origination and control will be too high to diffuse and small-scale green investments. But the biggest problem is the ever-growing appetite of financial institutions for liquid assets and, as a result, for carbon-intensive assets. You had a lot of examples about this problem. In this respect, our analysis shows that many pieces of financial regulation, from accounting rules to tax incentives on savings, are misaligned with climate goals. Thus, while our climate policymaker from the previous slide may be getting stronger, he is competing with another policymaker pulling capital in the other direction. So the focus of the 2-degree investing initiative is to study this specific problem and explore ways to fix it. So in the next 5 minutes, I will show you how investment processes in equity funds drive private capital away from the green economy for reasons that have nothing to do with profitability. So our journey starts with what is now called the problem of stranded assets that I've just been described. Oil and gas reserve will release carbon when they will be burnt. At the same time, the existing long-term energy-consuming assets like power plants, factories, buildings, vehicles are associated with what the International Energy Agency calls locked-in emissions for the next 10 to 40 years. The carbon content of fossil fuel reserves represent 3 times the amount of carbon we can release in the atmosphere to keep global warming below 2 degrees. At the same time, the carbon budget left for new energy equipment will soon be exhausted. In other words, investors who continue to invest in fossil fuels will either face stranded assets and impairments on their balance sheet or lead us to a plus 6 degree world. So, what are the implications of all that? Well, for financial institutions, the challenge of the energy transition is not limited to scaling up low-carbon investment. They actually need to reallocate capital away from fossil fuels and toward new technologies. This chart shows the scale of the necessary reallocation for the energy sector. As you can see, the current trend of investment is not in line with 2-degree investing roadmaps. So let's now have a look on the way equity investors contribute to either solving or increasing this problem. So many companies with very long-term assets may be impacted by the physical consequences of global warming. In a few years, they will very likely be exposed to policy and litigation risk related to their carbon emissions. On paper, households who indirectly own most financial assets have investment horizons long enough to worry about these policy and litigation risks. But it's on paper only. In the real world, nobody assesses these risks. Mainstream financial analysts just extrapolate current policy trends and have no forward-looking analysis beyond 3 to 5 years. Why? Because their clients, the institutional investors, don't care. Actually, they don't take into account long-term risk, as Sony mentioned. So for instance, let's take life insurers and pension funds who invest most households' long-term assets. They are supposed to be long-term investors, but it's on paper only. So on paper, they are supposed to keep a proportion of liquid assets to face their short-term liabilities and invest the rest in long-term assets to maximize returns. That's just what Sony described. But the analysis of the World Economic Forum suggests that they actually invest only 7% in illiquid assets like infrastructure and SMEs. Almost half of their assets are invested short-term only because of investment processes. One reason for that lies in subcontracting. As this chart shows, most fund managers have much shorter actual investment horizons than what they declare to their client. So the average holding period for a stock for long-term asset managers is like between 1 and 3 years maximum, and sometimes 6 months. One key reason for that is the use of short-term metrics. The performance of equity funds, as reported in financial press and set in most mandates, is defined relative to stock indices on a yearly basis. Internally, managers are evaluated on a weekly or monthly basis. The absolute performance over 8 to 10 years, which matters to the final client, is not considered at all in this process. What matters is beating the index every week, month, and year. As a result, most equity funds tend to mimic stock indices. And the exposure by sector, by industry, being the main driver of risk and performance, they reproduce the exact industry allocation of the indices. Now, the problem is, since mainstream indices are based on the market capitalization, they tend to favor large capitalization in the energy sector and exclude newcomers. The bottom line is an exposure of 10 to 15% to fossil fuels and less than 2% to renewable energies, even if we took into account the subsidiaries from the large capitalization. So this allocation strategy is obviously not in line with 2 degrees roadmaps, and it does not even reflect the current trends of investment at global level. So at the end of the day, equity investors are overexposed to fossil fuels and climate risks for reasons that have nothing to do with returns and only appear as a result of investment frameworks. Sorry for the seasick. Okay, so when I was advising investors, I did the math to understand the implications in terms of returns, of replacing fossil fuel stocks by renewables in their portfolios. Conclusion, during the past decade, performance are almost correlated, and renewables even overperform a little bit during most of the period. So at the end of the journey, this misallocation of capital by equity markets affect the cost of equity, but also the cost of debt. Indeed, equity valuation is the lighthouse of all financial markets. So to conclude, let's get back to our policymaker, and we will see how we can fix this problem. So to push capital in the right direction, this man, the policymakers, needs 4 things: a brain, a forward-looking vision, muscles, and safe tracks to avoid slippery grounds. So what we try to do is to build a 2-degree investing framework which is based on these 4 pillars. So a smart brain requires new long-term metrics. Our 3-year research program is focused on the development of a methodology to assess the alignment of investment portfolios with 2-degree scenarios. Do they deliver the expected capital expenditures in 2-degree scenarios? In parallel, we study the materiality of emerging climate risks, such as climate litigation, which is developing in the US and in emerging countries. We are, for instance, currently starting a study on this topic with Kepler Chevreux and a pool of lawyers. The idea here, which is very much in line with what Sony presented, is to stress test the cash flows of carbon-intensive companies in a scenario of mass litigation. So that's the first step. But such metrics will pave the way for new disclosure requirements. So today, when you select an investment product or a bank, you don't know where the money goes and what you actually finance. We advocate for disclosure of climate risks and performance metrics that I just mentioned in annual reports for companies and banks and in key information documents for investment products. So a regulation is currently debated at the European Parliament called TRIPS, which deals exactly with that. At the same time, the risk factors section of corporate annual reports are exclusively focused on short-term risk. You don't see anything on long-term risk. So we advocate for the inclusion of stress tests on cash flows for long-term risk in general and climate risks in particular. The last piece of the puzzle is to align incentives. Today, the understanding of regulations and tax incentives is very low among policymakers, and they don't understand how they interact with investment processes. For instance, evidence suggests that stock indices and other benchmarks, combined with short-term bonus schemes, may contribute to both the instability of financial markets and the misallocation of capital. So we are currently starting a study on this topic in partnership with HSBC and Allianz to try to find new solutions. Another key driver of investment decisions is tax incentives on savings interest. That's true in many countries. So we are starting, for instance, a study with the French government to understand how they affect the financing of the energy transition. Finally, the functioning of financial institution is complex, and it is important to road test any new metric, reporting requirements, or incentive. This is why we partner with governments, investors, and companies to jointly develop this 2-degree investing framework. So we invite all of you to join us and you can find us on our website. Thank you very much.
So a second initiative to join, that sounds very good. And perhaps we can join then a third one, and for this I warmly welcome Ingrid Holmes. You are Associate Director at E3G, and you are analyzing on how the public and private finance sector are reorganizing in response of the financial climate and economic crisis. And before everybody laughs, and as we are running out of time, I keep it very, very short and say over to you.
Thank you, Constance. So at E3G, we focus on how do you operationalize some of these ideas that people have been talking about today, and also how do we make the arguments to decision makers to get them to act in the right way. We've heard a lot, I think, about this wall of money that hopefully is coming. We've heard about the need for that money. A huge amount of capital needs to be invested in the low carbon economy, and we've also heard about how there are great opportunities for this money to be matched to. But I'll share two quick stories with you. I've spoken in the last month to two people who've raised funds for energy efficiency and are desperate for projects to invest in. There isn't stuff out there. EIB in 2011, I think, invested 30% of its portfolio into climate action projects. In 2012, that had fallen to 25%. Not because the EIB isn't committed to this agenda, but because the pipeline of projects isn't coming through. So I think in this module, we were asked to think about how we shift private finance. And I want to talk about how we create a systemic framework to enable that to happen. Again, this is a theme that's been discussed throughout the day. It's about systems approaches to dealing with environmental issues. So if we're going to shift this money into the places where there's a desperate need for it, I think we need a four-pillar approach. First, we need a plan. We need governments to understand they need to tell markets where to put that money, not to tell them how to do it, but to create the plan for investment, the shopping list, if you like. In the UK, we've got an example of this. We've got an infrastructure plan, investment in key infrastructure over the next 2 decades. Around £1 trillion is needed. Around 70% will go to low carbon or low carbon enabling assets. And in France, we've got a similar type of approach for the energy transition. So we need to know what the general direction of travel is. On top of that, something we've heard about several times today is a strong, long-term and stable regulatory framework. So this is about shifting the risk and reward balance away from high carbon and into low carbon assets. Because there's been so much uncertainty around government commitment to this agenda, increasingly investors are looking for what we call in the UK skin in the game. We want to see an alignment of public and private interests. So how do you best do that? We've had lots of experience with using guarantees and other types of one-off instruments. Increasingly, I think we're understanding an institutional approach is needed to this. The low-carbon transition is a multi-decade process, and we need dedicated capacity, financial capacity, to understand how to finance and deliver this. The Green Investment Bank in the UK, which was set up last year, is a good example of a scaled institutional response. It's not quite as big as we'd like it to be, but it's got a team of dedicated finance professionals working out how to get money in there, and at the same time advising governments on how to create bankable policy frameworks. We've also got examples back to the EIB, a cohort of people focused on renewables and energy efficiency, and I don't think it's an understatement to say some of the people in that team have helped keep the renewables market in Europe going through the financial crisis. And I think we need new institutions. We may need new banking components in some green banking components in some of our existing public banks, and we may need specialized delivery agencies, particularly for energy efficiency, which is a very hard to reach space. So why isn't this happening? I mean, my work 3-4 years ago at E3G started out focusing on finance, and it increasingly has become actually about institutions and about economics. Why? Because a lot of the decisions to implement some of these measures lie with our finance ministries, who are in charge of the public finance budgets. As we heard from Constanze earlier, there's recently been some light shed on this issue, particularly around where are subsidies going. So we've had the Twitter sphere going mad with numbers that DG Anna has put together on the amount of money going to fossil fuels versus nuclear versus renewable energy. And I think actually we need a lot more of that. We need to have an open and transparent discussion around the relative costs, because without that, we're starting to hear lots of misinformation on the unaffordability of the low carbon transition. That's clearly nonsense when you consider another statistic that was mentioned earlier today, the outflows from the European economy to fossil fuels bought in to meet our energy needs. So in 2011, that amounts to 6% of GDP. That's GDP that could have gone to investment in jobs at home. So I think with this kind of information out there, with this kind of debate, we could start to really have a measured discussion on delivering this low-carbon economy and start to get to some solutions. Now, because I'm a diligent speaker, I read my instructions, and in the instructions it mentioned, how can the European semester process be improved? I'd never heard of the European semester process before that point, so I looked it up. And it sounds like a good place, actually, to start having these discussions. So apparently this is a place where member state budgets and economic policies are assessed to see whether they're in line with EU objectives. I wonder if actually, as part of that process, we could start to assess those budgets and those economic policies for resilience against future resource scarcity, so rising energy prices, water scarcity. So in an unheated way, take a cool and analytical look at how fit for purpose some of the budget allocations and the policies being implemented in member states could be in the face of a changing climate. And there I will leave it.
Thank you very much, Ingrid. That was a very good summary and I think a very good opening of the debate. Just in brackets about the European semester, here I am, I'm working on that. So perhaps we could have a coffee chat on the European semester. I'm inviting everybody. But I would like to open the floor now for questions. Please keep it short. I will collect your questions and just state your name, use the mic, business as usual, and just tell us shortly where you are, who you are, sorry. Any questions? No questions.
Oh, there's one in the back.
Oh, sorry, yeah.
Hi, sorry, it's an obligatory question. It seems to be from me, Andy Miles, Scottish Environment Link. I'd like to ask the panel if they think that nuclear energy is really a low-carbon energy source and a worthy investment, particularly as it has no market validation by insurance markets and companies. The insurance companies wouldn't touch the nuclear industry with a barge pole. In the UK, I know that over 80% of the budget of the Department of the Environment and Climate Change is actually spent on disposing of nuclear waste, and that so far in the UK, over £76 billion of taxpayers' money has been spent on the nuclear waste issue. Is it really a low-carbon fuel, and should it be invested in as part of the transition to a green economy?
I've had a second question from Christian, and I see two others, and then I would close the...
Christian Ege from Danish Ecological Council. Question to Jonathan Taylor. There was a discussion about a coal-fired new power plant in Kosovo. I don't quite remember the role of the European Investment Bank and the World Bank, but I would ask what could make your investment bank decide not to invest in coal-fired power plants?
Thank you so much.
Hi, Samuel Martín Sosa from Ecologistas en Acción in Spain. I must confess that I am scared of financial markets. I mean, because the speaker from Redesign mentioned a couple of investment fields, which I think everybody would share. I mean, like light bulb changing or refurbishment of buildings. But if we talk about other issues, like, for example, water or biodiversity, I would be a bit scared to let financial markets to put its hands on these common goods. Because when you let financial markets to have access to these goods, these goods become tradable commodities. Now the financial banks, like for example the EIB, is pushing for biodiversity offsetting. Even the UK is planning to introduce this in their legislation. The EU is also with an initiative, the no net loss initiative. I mean, we have been shifting from speaking about halting biodiversity loss. Now we talk about no net loss, which is a big difference. It may sound a slight difference, but it's a big difference. And as far as it's been essayed so far, the biodiversity offsetting, it has undermined planning laws that prevented destruction. This means that offsetting possibility has been used to allow destruction that should have been prevented by legislation. And also because to give economic value to these commodities means relying on dubious calculations done by experts that decide what the value of the lost biodiversity is, and creates new assets for speculation. And for me, this is something that gives me lots of concerns. I mean, I don't have a clear idea on this, but I would be scared about this. Thank you.
There was the last one over there, Christian.
My name is Jaap Mooiweer from the Dutch Association for Cultural Landscapes, and we're working on a daily basis in estimating green infrastructure. And I've got a question for the EIB and the pension funds. How do you look at market failure? If you try to get investment for green infrastructure, and we start speaking with pension funds, they said we need governments to back you up. And if you start speaking with governments, he said you have to go to the Green Investment Bank, the National Green Investment Bank, but they ask you an interest of 4 or 5%. These investment in green infrastructure can be profitable, but most of the return on investment is scattered. Like different parties get the profit instead of the party that's investing. So how do you look at this problem? Look at the problem of market failure in this case?
Thank you very much. I would close the panel, except if there's any urgent thing that can't be left out. Okay. I would perhaps, Sony, ask you to answer the last question on infrastructure. Is that okay? Mr. Taylor, on the Kosovo nuclear to Stan and water biodiversity, perhaps to Ellen, is that okay?
Well, if I may, I think the question on the last one was specifically directed at you, but I just want to add a couple of points. So here's the thing that, so at an emotional level, I care very deeply about the environment and development and stuff, but I also know that there's two parallel worlds. There's the world of the central banks and the finance ministries and DG ECFIN and the investors, and then there's the world of environmental, concerned and aware people, and these worlds don't often meet. And our job at what we do is to basically connect these worlds. So I'm going to be very cynical. Now, if I only use a financial risk-return framework, and this is the very crucial point, I apply no ethical criteria, I apply no moral guidelines, I will more or less come to the same conclusions based on a thorough analysis with a pure financial market perspective as everybody else who is coming at this from an environmental aspect will. And the failure is in connecting these two. And that's, I think, the most important thing. Just let me give you a quick example. So what you have is that there are two sort of revenue streams. So imagine there's profits that come like this, they're steady. And then there's profits that come like this. Now, one would think if the total sum over 10 years is the same, what's the difference? And the difference is that most people like this better than this. And it may be that in 10 years this ends up being the same as this, but it may not be. So there's a much greater risk. What it basically means is that this additional risk or volatility or uncertainty actually has a financial value which can be translated. And what we are failing to do is we are underpricing the risks that arise from the continuing dirty investments, from the continuing dependence on volatile fuel prices, fuel imports, etc. And this is even notwithstanding the security risks that arise from, sending money into, let's say, Saudi Arabia, etc. On the one hand, and we are underpricing the potential profits that come from green investments, because we are within companies, within the financial system, within policy-making community, all responsible for that same short-termism. Short-termism is not specific to the financial sector. The term of the Commission is 5 years. The term of the Norwegian government is 4 years. and we are ignoring all the benefits, all the financial benefits, all the profits that accrue over the next 15 years after the next 5 years. And if you only were to sit down, look over a 20-year horizon without any moral glasses on you at the numbers, it adds up to a very substantial financial case where green investments from where you are of all kind look much more attractive on a pure profit risk basis than the so-called dirty investments. And the macro case, and this is our big challenge in the policymaking community. And on that personal note, just to mention nuclear power. Now, I may not be in the majority in this room, I'm not sure. I'm personally skeptical because of the time horizon involved. So over the, if you're really long-termist, if you're short-termist, all you're going to look at is the storage problems and the potential risks with earthquakes and whatever of nuclear fuel storage over the next 10, 20 years. But in truth, the half-life of some of those isotopes is like 20,000 years or 30,000 years. And I can assure you that on a cost-adjusted basis for over 10,000 years, nuclear power is completely uneconomic. And the question is, if we are able to inflict this into the future, or we are able to inflict this on somebody else, or we are able to ship this to some remote island in the Pacific or something, then it all may be okay. But if we are forced to, so just again on that same risk-return basis, I have nothing against nuclear power. If we find a way of making nuclear power without isotopes of 20, 30,000 half-life, very radioactively damaging isotopes, I'm all for it. But under the present technology, I think there's a serious problem.
And just, if you allow me, just under brackets, come back to me, because we released a very interesting story that shows that you don't need 10,000 years. You can show it within the last 50 years that it is much more expensive than renewables. But I would like to hand over perhaps to the Kosovo question from Christian, and would like to ask you, Mr. Taylor.
Sure. I mean, I can answer it, and I can also answer it in passing, as it were, a number of other questions, because they're wrapped up in the same answer. As you know, indeed, you probably submitted to it, we may have done. We had an extensive consultation earlier this year about a new energy policy, and we published that energy policy in July. And one of the aspects of that energy policy is that we've set ourselves emissions performance standards, 550. Now, some people would have hoped for a more, I concede, some people would have hoped for a more ambitious number. But it is, having said that, I would point out that this is, we're the first multilateral financing institution that's done that. We've set out a number of other standards within that. It follows from that. And by the way, everything which we set out in our energy policy review, as it were, sets a framework against which we then consider the viability of individual projects. I think it follows from that, if you look at the numbers, it follows from that we have not excluded ever investing in coal again. We've not excluded, but it would be clean coal. We've not excluded doing that, but it follows from that the likelihood that we will be doing significant investment in coal in the future is very small. So that answers, I think, the question. At least it answers the question as best as I can answer it. I think it also applies to some degree to some of the other points as well. I mean, indeed, it applies, you could say, to nuclear.
Thank you very much. Leaves us to the last question on water, biodiversity. Anybody from YouTube perhaps to pick that up? Stan?
I'm not sure I catched exactly the question
Okay.
on biodiversity.
Anybody, could you perhaps repeat your question? It was on how to. It was on. Well, it's if I'm correct. It is fine to have now to concentrate on CO2 emissions and to look into pricing mechanisms, how to make them more attractive, well, let's say more equitable. But what about water and biodiversity, so other environmental measures that also are of financial interest?
Okay, so I can just briefly describe what the investors are starting to do. I mean, we are like in a turning point. In the past decade, investors used to assess what is a responsible investment based on very qualitative things like processes, decision-making processes within the companies, management frameworks. now they start to introduce metrics related to impact. And so that's the new trend, I would say, and that can help to avoid greenwashing to a certain extent. And in this trend, the priority is definitely carbon emissions because it's easier to measure. So I think for the next 5 years, they will probably concentrate on this topic rather than water or biodiversity, just because it's more difficult to measure. But probably 5 years after, they will start to turn biodiversity risks and water stress as new indicators. And the other thing which is very important is that when you try to link carbon emissions with financial risk, in many cases you figure out that the risk related to carbon emissions are actually like side effects related to local pollution, water stress, and that many coal-fired power plants that are obliged to close in the US or in other countries are impacted by the restrictions related to air quality standards rather than carbon emission standards. And so there's a strong connection between those impacts.
Thanks a million. Before I get kicked off of the EEB, I have to stop here. I think what I will not do is to leave you or to let you leave this room with a very rounded up summary, because I think this is the value of this panel, not to make a summary, but to open a lot of boxes and to open it of questions. I'm quite sure you don't need the coffee now because you must have waken up now, but I leave you at least for 20 minutes. So I would like to ask you to be back 5 past, 35 past, sorry. That means 25 to 5. Enjoy your coffee, have good talks, and see you later. Thank you so much for my excellent panel.